The Federal Reserve just made a move that, on the surface, appears routine, yet for the first time in modern history, it reveals a truth that no one at the press conference will state openly. The Fed is effectively paralyzed. They cannot cut rates, they cannot raise rates, and they cannot fully explain to the public why oil prices are surging past $100 per barrel while inflation stubbornly refuses to ease. Core inflation is at 3.1%, signaling that the economy is slowing, yet the pressures on prices are intensifying. Oil is above $100 per barrel, and the individual controlling the world's most powerful monetary institution is simultaneously under criminal investigation by the president, who is preparing to replace him with someone openly committed to rate cuts, no matter what the data shows. Publicly, the Fed will insist nothing has changed. Privately, the mathematics have already dictated the outcome. And gold, which has quietly absorbed the unspoken signal, is on the verge of entering a phase that historically produces its largest price moves ever. By the time the press conference concludes, the markets will have delivered a verdict, not on the rate hold itself, everyone already knows that, but on something far more critical: whether the Federal Reserve retains any meaningful room to maneuver. When examining the full picture, the answer is a stark no. Yet the real story isn't about a simple rate hold or the words spoken by Fed officials. It's about what this meeting reveals about the three-phase gold bull market and why the phase that has just begun historically generates returns that make phase one look like a mere warm-up. I've spent 40 years observing central banks navigate impossible arithmetic. I've seen them forced to choose between bad options and worse options, and I've seen them craft language to obscure the obvious truth that the numbers reveal. Throughout that time, gold has consistently priced in the reality that central banks refuse to admit months before the public acknowledgement arrives. Today, I'm delivering the most precise diagnosis of central bank paralysis in my career. I will outline the difference between a central bank that chooses to hold rates as a deliberate policy decision to optimize economic outcomes and a central bank forced to hold rates because every other available option would produce a worse crisis. Understanding this distinction is critical for anyone invested in gold, bonds, silver, or any dollar-denominated asset. The trap the Fed finds itself in is unique. Right now, interest rates are held at 3.75%. The market had priced in this outcome at above 99% probability, making the decision a foregone mathematical inevitability, not a discretionary choice. Yet the number that truly matters is not the rate itself, it's the trap behind it. On one side, core inflation is running at 3.1%, moving in the wrong direction at precisely the worst possible moment. Brent crude surged past $125 per barrel in the weeks following the Iran conflict, and every additional dollar in oil prices adds cost-push pressure to an inflation metric already 55% above the Fed's 2% target. On the other side, GDP growth collapsed to 0.7% in the last quarter of the previous year, a stark fall from 4.4% just one quarter earlier. Unemployment has risen to 4.4%. Manufacturing has contracted for 9 consecutive months, and American consumers are absorbing significant tariff costs, along with the early stages of oil-driven gasoline and grocery price increases that haven't yet fully materialized in official data. The trap is complete. Cut rates to stimulate growth and risk, reigniting inflation already worsened by oil, hold rates, and accelerate the slowdown the economy is already experiencing, or raise rates, and risk detonating $9.2 trillion in Treasury debt that must be refinanced this fiscal year at already exorbitant interest costs exceeding $1 trillion annually. There is no fourth option. The Fed is trapped, and Jerome Powell, facing criminal investigation for refusing to cut rates under presidential pressure, will deliver a carefully calibrated statement designed to obscure the reality most investors fail to perceive. Gold, however, has been pricing this trap for months. The number that should alarm any careful observer is $245 billion. The cumulative loss the Fed has recorded on its balance sheet since 2022. By conventional accounting standards, this central bank would be insolvent. These losses arise because the Fed pays commercial banks 3.65% interest on reserves parked with them, totaling over $3.3 trillion, while the assets they hold, treasuries and mortgage-backed securities, yield far less. This mismatch has created 3 consecutive years of cumulative losses, carried on the books as a deferred asset under the Fed's unique accounting rules. Meanwhile, the Fed began quietly creating $40 billion per month to purchase short-term treasuries last December. They called it reserve management purchases, avoiding the labels quantitative easing or money printing to prevent triggering public or market backlash. This adds nearly $500 billion in new money each year, and it's happening silently. Having watched central banks for 4 decades, I can assure you that when such an institution changes the terminology of its actions while continuing the practice, it is deliberate. They are controlling the narrative, attempting to avoid a reaction, and that reaction is precisely what gold has already begun to price. This is phase 2 of the 3-phase gold bull market, which began 3 months ago. Phase 1 was the calm, institutional accumulation stage, where central banks and sovereign wealth funds quietly reduce dollar exposure. Phase 2, which we are entering now, is driven by the market's realization that the central bank can no longer manage the monetary system without choosing between 2 destructive options. Phase 1 of the gold bull market was methodical, steady, and almost surgical in nature. Institutional players moved quietly, accumulating gold and reducing dollar exposure without causing sudden price swings. Central banks purchased 1,037 tons of gold in 2023, 1,045 tons in 2024, and 863 tons in 2025 each year, surpassing the historical average and making each subsequent ton more expensive than the last. The key for Phase 1 investors was not timing the market, but strategically positioning ahead of broader awareness. Phase 1 does not end when central banks stop buying. It concludes when the general market finally understands why they were buying in the first place. Phase 2 begins with recognition, not with crisis. It starts when investors realize that conventional policy tools are insufficient, that the central bank is trapped, and that monetary debasement is inevitable. Historical examples illustrate this pattern clearly. In 1971, the pivotal moment was Nixon closing the gold window, which set off a new phase for gold. In 1979, the Fed under Paul Volcker faced a choice between suppressing inflation with 20% interest rates or driving the economy into a deep recession, and the market recognized the inevitability of extreme monetary responses. Today, the trigger is this: Federal Reserve meeting. Rates were held while oil surged past $100. Inflation hovered at 3.1%. GDP growth collapsed to 0.7%. And the incoming Fed chair has already been publicly aligned with a political mandate for 1% rates. Phase 2 is not defined by overt money printing. It is defined by market recognition that such printing is inevitable. The Fed's quiet $40 billion monthly reserve management purchases are already being priced into gold, even though the official acknowledgement has not yet occurred. Phase 3, by contrast, is when the printing becomes undeniable, when the magnitude of liquidity creation can no longer be disguised, and when inflation begins to erode purchasing power in every dollar-denominated portfolio. The transition from Phase 1 to Phase 2 is the most critical inflection point in any gold bull market. Phase 2 delivers the outsized returns, the rapid wealth creation that Phase 1 merely hinted at. Missing this transition often costs investors the opportunity to capture the most significant gains. 3 layers confirm the onset of Phase 2 in the current market. Layer 1 is the impossible arithmetic of the $9.2 trillion federal debt refinancing wave. This year alone, the U.S. must roll over $9.2 trillion in maturing debt, equivalent to 3 times the market capitalization of the world's largest company. At current interest rates, the annual interest expense is already $1 trillion, exceeding the entire defense budget. Raising rates to combat oil-driven inflation would push this cost even higher, while holding rates ensures that foreign creditors are earning a negative real yield as inflation outpaces the return on their holdings. Cutting rates to stimulate the economy adds fuel to an inflationary fire already intensified by oil. Every path carries a cost, and each cost ultimately threatens the credibility of the US dollar. Layer 2 is the succession trap. The incoming Fed chair, Kevin Walsh, is scheduled to take office in May 2026. He was nominated by a president who publicly demanded rates at 1% or lower. Market participants know this, and the challenge Walsh will face is binary. Either he cuts rates in alignment with the political mandate despite inflation pressures, or he resists and confirms that the economy is trapped in stagflation. Either outcome validates phase 2 of the gold bull market. If he cuts rates, the Fed's independence is gone. Monetary debasement is publicly acknowledged, and gold reacts accordingly. If he holds rates, the stagflationary trap is undeniable. The economy will slow, and gold again benefits. The question is not whether phase 2 is triggered, it's about timing and magnitude. Layer 3 is the private credit time bomb. Historically, phase 2 triggers emerge from the financial system rather than the government directly. In 1929, it was the stock market. In 2008, the housing market. Today, the leveraged and opaque private equity and private credit sectors, controlling over $4 trillion in assets, are vulnerable. Roughly $440 billion of these funds are zombie funds, unable to liquidate underlying assets, relying on financial engineering to survive. When economic pressure forces these unrealized losses into the open, they flow into the banking system, creating systemic strain. The only institution capable of intervention is the Federal Reserve, and the tool it is quietly deploying, reserve management purchases at $40 billion per month, is already in motion. Gold's current behavior confirms this framework. The metal is holding the structural support level representing the phase 2 accumulation floor. This level is not arbitrary. It reflects consistent absorption by central banks and sophisticated investors who are absorbing supply despite short-term selling pressures. The gold-silver ratio, near 57, signals that leveraged outperformance in silver is imminent. Historically, when this ratio compresses and snaps back, silver outperforms gold by 3 to 5 times. Mining stocks also remain undervalued relative to current gold prices, as retail investors have not yet entered phase 2. When gold rises, mining company margins expand dramatically because production costs are largely fixed. A $50% increase in gold can translate into an 83% increase in a miner's profit margin, highlighting the leverage inherent in the sector. Additional phase 2 signals are present in the broader financial system. The 1-0-year Treasury yield has resisted the flight to safety bid that normally drives rates lower during equity volatility, signaling that bond markets are pricing in the $9.2 trillion refinancing, Fed losses of $245 billion, and the oil shock. The U.S. dollar is weakening, contrary to historical expectations during global crises, indicating that its safe haven premium is being questioned. Institutional positioning is already in place, while retail awareness lags. The gap between institutional understanding and retail perception defines phase 2, just as it defined phase 1. Phase 2 windows historically close faster than phase 1, making early recognition critical. To understand why phase 2 produces the most explosive returns, we need to look at history. Phase 1 moves are driven by methodical, institutional repositioning. The smart money accumulates quietly, careful not to push the price against themselves too aggressively, because every early misstep in timing is costly. They focus on strategic allocation over short-term gains. Phase 2, by contrast, is driven by recognition by the market collectively realizing that monetary debasement is inevitable. Once that recognition hits, the moves are compressed, accelerated, and massive. Phase 2 is the stage that defines gold bull markets, the stage where fortunes are made rapidly. Missing the early signals means investors are left chasing a market that has already priced in the most substantial gains. The parallels to 1979 are instructive. The Iranian Revolution pushed oil above $40 per barrel, which created an inflationary environment that made the U.S. dollar's debasement mathematically certain. Gold responded with a 276% gain in just 12 months, not because retail panic drove prices, but because the market understood the inevitability of central bank responses. Similarly, in 2026, the setup is even more extreme. Debt levels are higher, policy tools are constrained, institutional buying bases are broader, geopolitical pressures amplify dollar devaluation, and industrial demand for silver is more inelastic. The fundamental conditions that made Phase 2 explosive in 1979 are now magnified across multiple structural dimensions. Institutional forecasts underline this dynamic. J.P. Morgan projects a year-end gold price of $6,300. Deutsche Bank stands at $6,000, and Goldman Sachs spans $5,900 to $6,300. These are not speculative guesses, they are calculations rooted in the mathematics of debt, monetary policy, liquidity creation, and geopolitical pressure. The distance between today's trading price and these targets is not about sentiment, it is about the inevitable mechanics of Phase 2. Institutional positioning, structural flows, and monetary constraints are already embedded in the market, setting the stage for the largest gains to occur rapidly once the broader market recognizes the framework. This brings us to the crucial distinction for investors today. There are two types of observers watching this Federal Reserve meeting. The first sees the rate hold and concludes that nothing has changed. Inflation is being managed, the crisis is contained, the system remains stable. They will rely on the press conference statements, carefully crafted to project control, and will wait for visible confirmation of market movements before taking action. By the time these investors react, the Phase 2 move will already be well underway, and the majority of outsized gains will have been captured by those positioned early. The second type of investor, however, sees beyond the surface. They read the rate hold as a signal embedded in the Phase 2 framework, a Fed trapped by oil, debt, and political pressure, an incoming chair publicly aligned with rate cuts, and ongoing, subtle liquidity creation under the guise of reserve management purchases. For these investors, the Fed's paralysis is unmistakable. They understand that gold, silver, and related assets are already pricing in the inevitability of monetary debasement before any overt confirmation. Their positioning is proactive, strategic, and informed by the structural realities that will drive returns in Phase 2. The historical context further clarifies why acting early is so critical. In the 1970s, Phase 1 of the gold bull market transformed $10,000 into roughly $35,000 over 5 years, a solid return, but modest relative to what Phase 2 delivered. Phase 2 of that same cycle turned the same $10,000 into $243,000 in just 4 years. The difference is staggering. The bulk of wealth creation occurred in Phase 2, during the compressed period when the market collectively recognized the inevitability of currency debasement and responded aggressively. Phase 1 provided a foundation. Phase 2 delivered exponential growth. Missing the transition from one to the other is the reason most investors fail to capture the full potential of a gold bull market. Phase 2 moves are inherently rapid because they are reactionary. When the market recognizes structural inevitabilities, price action is no longer dictated by methodical accumulation but by a collective rush to reposition in real time. The catalyst is never gradual. The movement is compressed, front-loaded, and accelerated. Retail investors typically arrive too late, often entering after the major gains have already been captured. Phase 2 is therefore defined not just by direction but by speed, the speed at which the market internalizes structural constraints, monetary policy limitations, and geopolitical pressures. This is why today's Federal Reserve meeting matters so profoundly. It is not the rate decision itself that drives markets. It is the implicit confirmation of Fed paralysis. The market understands that conventional tools are exhausted, that every policy choice carries catastrophic consequences, and that monetary debasement is unavoidable. Gold and silver have been pricing this reality for months, while the broader investor base remains largely unaware. Phase 2 is underway. The signals are clear, but the majority of participants are still on the sidelines. Acting now ensures participation in the structural revaluation before consensus catches up. Gold's support level and the gold-silver ratio confirm the leverage inherent in this phase. Mining stocks are undervalued, bond yields are reflecting risk, and the U.S. dollar's safe haven premium is under question. These signals collectively form a structural roadmap for Phase 2 positioning. The difference between observers who understand these signals and those who wait for confirmation is measured in multiples. The former capture the bulk of the upside, the latter are left chasing gains at higher entry prices. The current moment is one of undeniable clarity for informed investors, marking the point where Phase 2 transitions from theory to actionable reality. The key takeaway for investors is that Phase 2 does not wait for confirmation. It begins the moment central bank paralysis becomes undeniable. Today's Fed meeting has made that paralysis visible to anyone paying close attention. The conventional metrics, the rate decision, inflation reports, GDP numbers are distractions. The true signal lies in understanding the constraints that prevent the Fed from acting, the quiet liquidity being created, and the political pressures shaping future monetary policy. Recognizing these signals before the broader market does is the difference between capturing the outsized gains of Phase 2 and watching them unfold from the sidelines. Consider gold's structural support. This is not an arbitrary line on a chart. It is a level where institutional buyers, sovereign wealth funds, and informed investors have consistently absorbed supply. Every time gold tests this floor, it is met with strategic buying, indicating that those who understand the Phase 2 framework see the value and are committed to accumulation. Silver, historically leveraged to gold in Phase 2 moves, is signaling similar dynamics. Its ratio to gold, currently near 57, is compressing in a pattern that has consistently preceded outsized gains in past bull markets. Mining stocks, still undervalued relative to gold prices, offer another layer of leverage. Their margins expand disproportionately as gold rises, creating exponential upside for investors positioned before Phase 2. Acceleration. The U.S. Treasury market and the dollar index reinforce the signals of Phase 2. The 1-0-year Treasury yield, refusing to decline amid volatility, indicates that the bond market is already pricing in the $9.2 trillion debt refinancing, Fed losses, and oil-driven inflation pressures. The U.S. dollar, traditionally a safe haven, is weakening even as global uncertainty increases. A Phase 2 signature showing that confidence in conventional dollar-denominated assets is being questioned. Taken together, these factors paint a clear picture. The structural foundations for Phase 2 moves are fully in place. Historical comparisons underscore the magnitude of what is unfolding. In the 1970s, Phase 1 produced steady, methodical gains, but Phase 2 delivered the true wealth-building opportunities. The transition between phases is defined not by a single event, but by recognition, the market realizing that monetary debasement and fiscal constraints make the current system unsustainable. In 2026, this recognition is arriving in the form of Fed paralysis, ongoing covert liquidity creation, and the political environment influencing future rate decisions. Investors who grasp this context now are effectively front-running the broader market's awareness. The stakes are immense for those holding gold, silver, or dollar-denominated assets. Acting after the Phase 2 move becomes obvious is costly. As entry prices rise and the window for capturing outsized returns narrows. Phase 2 is defined by speed and compression. The longer investors wait for confirmation, the more of the structural upside is already priced into markets. Understanding the signals before the consensus forms is the difference between incremental gains and transformative wealth creation. For investors watching this Fed meeting, the lessons are clear. One group will see stability, a controlled system, and will wait for conventional confirmation. They will miss the early gains. The other group, informed by structural dynamics, Fed constraints, and the subtle liquidity injections already underway, sees the Phase 2 configuration with clarity. They understand that gold, silver, and mining stocks are poised to capture the largest moves in decades. Their actions today, based on signals embedded in this meeting, determine whether they participate in the exponential returns Phase 2 delivers. Ultimately, Phase 2 is about positioning ahead of broad recognition. The Fed has made its move, revealing a system constrained on every front. Gold and silver have already internalized these dynamics, reflecting the inevitability of monetary debasement. Phase 1 built the foundation, and Phase 2 delivers the explosive growth. The lesson is simple. Timing matters, recognition matters, and understanding the structural realities behind central bank actions matters more than any headline or press conference statement. The choice for investors is immediate. Will you wait for confirmation from the crowd, or will you act on the signals that are already clear to those who understand Phase 2? The mathematics, history, and current market structure leave little room for hesitation. The Fed's constraints are observable, the liquidity injections ongoing, and the political pressures influencing future policy undeniable. Phase 2 is underway, and the opportunities it presents are as immense as they are time-sensitive. The final takeaway is this. Phase 1 turned $10,000 into $35,000 over 5 years. Phase 2, historically, turned the same $10,000 into $243,000 in roughly 4 years. The scale and speed of returns are concentrated in this phase because it is driven by market-wide recognition of structural inevitability, not by methodical accumulation alone. Today, the Fed has revealed the paralysis, gold has responded, and the Phase 2 window is open. The decision is yours. Position now, or watch the move unfold at a higher cost, knowing the greatest gains will have already been captured by those who understood the signals in time. The Federal Reserve made its move. Now you understand what it means. The market is already pricing the reality the Fed cannot say aloud. Gold, silver, mining stocks, and other dollar-denominated assets are the instruments through which Phase 2 gains will materialize. The opportunity is here, and it is anchored in observable, verifiable, structural signals. Those who grasp it today are in position to participate fully. Those who do not will look back at this moment, wishing they had.